Is now the time to buy bonds? Well, with some bond prices having fallen by over 20% in the last 12 months, it could be argued that if you enjoy bottom fishing, now might be a good time to pick up some bonds at a bargain price, lock in on some good interest rates and the possibility of capital appreciation. However, there are risks to this, and I'm going to outline in this video my views on bonds, and we're going to look at all sorts of different ways you can analyse and invest in them. What is a bond? It's basically one party lending money to another over a specified time period that could be indefinite, with a specified amount of interest to be paid each year in a particular currency. So all the returns from bonds are fixed in nominal terms, just like your mortgage. So then the types of bonds that we have are government issued ones, corporate bonds issued by companies. There's different durations from just a few months to 30 years. There's different currencies, so GBP, US dollars, or even Argentinian pesos. And some government bonds are index linked or they have inflation protection. Why do people hold bonds? Well, basically there's quite strong asset backing behind bonds in terms of ideally you will get your money back, so there's some capital certainty there. Ideally they have lower volatility than stocks, where the earnings can fluctuate quite a lot over time, and potentially bonds might rise in price when equities fall if there's this flight to safety, and there's a potential trade-off between risk and return where bonds have potentially lower risk and they will probably offer lower returns, but sometimes that is a trade worth taking. Bond prices move inversely with interest rates. So if you imagine a 10-year bond paying 2% interest, after year one, interest rates rise from 2% to 5%. So on a £100 bond, the interest shortfall is 5%, that's the market rate you can now get, minus 2%, that's the rate on the bond that we've bought, times by 9 years remaining on the bond, so £27. So the bond needs to fall at, by most, £27 to equalise the returns between existing bonds and the current bonds issued at the higher interest rate. And so the longer the duration of the bond, the more volatile its price will be. Bond prices could take a long time to recover. So here we've got Vanguard UK government bonds, and when the interest rate was 0.1%, price was about £26. Now the base rate is 5% and the price is around about £16. So they've fallen in value quite quickly, but I'm not so sure how long it will take for them to fully recover. Bonds can in theory have negative correlation with equities during a recession, provided that interest rates are being cut and hence bond prices will rise, and the interest rate cut is being done to boost the economy. However, if inflation is high and rising, then bonds could fall at the same time as equities as interest rates rise to try to reduce inflation. So a lot of the things you've read about bonds in the past aren't really applying at the moment, and that's why bonds are currently quite a risky thing to have. Here are some different types of bonds and their 1-year return and 5-year returns. These are exchange traded funds. I've got the data from justetf.com. So the largest ETF is a corporate bond fund, negative 8% over 5 years, 7% over 1 year. Some UK gilts, negative nearly 20% over 5 years, 14% over 1 year. Some shorter duration UK gilts, where a gilt is a government bond, 0 to 5 years, minus 5% over 5 years, minus 4% over 1 year. Short duration corporate bonds. Ultra short bonds, these tend to be quite similar to a cash account, so they're maybe like 3 months on the duration, so those have had positive returns. And rather bizarrely, index linked, so they're linked to inflation ideally, have lost 22% over 5 years and 18% over 1 year. So my mantra is, if you don't understand it, don't buy it. And here are the prices of some index-linked UK government bonds, and when inflation rises, you would kind of think, well, it's going to pay out more money, so it's potentially something worth having, but actually the price falls. So that's a bit odd, and when I read the fact sheet I still couldn't really quite understand what was going on. So for me, I'm just going to give UK index-linked gilts a pass. So all this has got me thinking, who does actually buy bonds? Sometimes it's workplace pensions, sometimes it's people advised to do so by financial advisors because they've been told they're risk averse. But the problem is that economic relationships and correlations can break down over time, and don't be stuck looking in the rearview mirror. So with corporate bonds, there's an asymmetric risk. If the bond issuer defaults, you could potentially get nothing, so there's a 100% downside. But if everything goes to plan, you get what the contract stipulates, so there's a 0% upside. So unlike equities, where if the business innovates, sells into new markets, there's all kinds of ways you can capture quite a lot of upside. With bonds, that really just does not occur, so as a long-term hold, they're not really a very good proposition for me. So how much of my portfolio should be in bonds? Well, people used to talk about the 60-40 equity bond split portfolio and how that had quite smooth returns over time, but that was the historic relationships. People have even said, well, you should be more like your age in bonds. So if you're in your 30s, you have more like 30% in bonds. But I think that's maybe a bit too much exposure. All you really need is the duration of a market downturn, so maybe like 3-4 years, so you've got this kind of ballast in your portfolio. If equities do badly for a few years in succession, you've got some bonds that you can sell and use that to finance your retirement. Should I hold bonds separately or within a multi-asset fund? So examples of multi-asset funds include Vanguard Life Strategy, where it's got anything from, I suppose, no bonds to 80% bonds wrapped up within the fund. And I think that can be quite confusing, because when the fund doesn't do very well, you've got to unpick what's going on with bonds and what's going on with equities so you can decide what you want to do about it. The advantage of these funds is that they automatically rebalance for you, so you don't really have to do anything. You can just hold the fund, but you need to, before you've actually bought it, do a lot of detailed research to understand whether that is really what you want to buy, including the quite large UK exposure that Vanguard Life Strategy has. There's also things like Capital Gearing Trust that can have quite a lot of exposure to bonds, and this can pivot between value equities, gold, and different types of bonds, including index-linked bonds, as it sees fit. So it can be quite a good strategy, but recently even Capital Gearing Trust has come under pressure, and so its idea of being a very defensive fund is starting to be questioned. Should I hold active bond funds or emerging market bond funds, or maybe neither? Well, returns on bonds are low, and they don't really justify the active manager fees of a strategic, that's what I often like to call them, bond funds. So my preference would really be a bond ETF rather than an actively managed bond fund. And emerging market bond funds, even if the bonds are ultimately denominated in US dollars, can potentially carry too much risk that could wipe out returns, because in the time between buying it and selling it, you might find that it's actually had no capital growth due to what's been going on in these emerging markets, so it wasn't such a safe haven for you after all. What about an individual bond versus a bond fund that held several bonds within it? Well, individual government bonds can be difficult to buy. They can have low liquidity, so much volume traded, and a wide bid-offer spread. But at least you've got the certainty of exactly what's going to happen because you've only got the one bond. Bond funds don't have a specific maturity date. They keep buying and selling, so they may actually never get back to their par value. And that's really the problem with bond funds, that they're just rotating around all these different bonds, and that ultimately they could be selling at prices that are lower than what they have to buy to keep the bond fund going. So here's an individual corporate bond issued by Vodafone, 5.9%, maturing 2032. Price is about £1, but there's quite a big gap between the buying price and the selling price, which is almost a year's worth of interest. So it has fallen quite a lot in recent times. And I mean, if you did want some money in 2032, then maybe this is an optional one way to get it, but you're taking a bit of a corporate risk against Vodafone. But hey, at least it's not Thames Water. Are stocks expensive compared to bonds? Well, they say what you need to do is compare the 10-year bond yield to the earnings yield of the stock market. So currently the 10-year government bond yield is 4.3%, and the earnings yield, which is just the inverse of the price to earnings ratio, for the FTSE All Share it's about 6.9%. So there is an equity risk premium in place, so I would argue that the markets are quite fairly priced really between stocks and bonds, so I don't think there are bargains to be had on either side. What is the outlook for interest rates? Well, who knows really. I mean, we could be at the peak of the cycle, in which case it would be quite a good time to buy bonds, but it is difficult to know, and you shouldn't really try and front run things and anticipate what's going to happen in the future. Interest rates could fall, but although recently we've seen a discount from the interest rate off the inflation rate, that might not persist. So that's what's meant by negative real interest rates. And who would lend out money at 2% if the inflation rate is 5%? Just doesn't make sense. So interest rates might stay high for quite some time. So my conclusion is it's difficult to buy bonds anticipating a meaningful interest rate decline. So my conclusion is that bonds come in many different guises, and some have more default risk in terms of junk bonds from corporates and volatility than others. But there's really not much difference in returns between a government bond and having £85,000, which is the government protected limit, in a really decent savings account. And changing inflation and interest rate expectations mean, in my opinion, there's no bargains to be had. So stick with your stocks, put some money into a savings account would be my suggestion, but it really depends on your risk profile and the research that you've done.